This
There you go.
conference will now be recorded.
Hello, and welcome to our 7th weekly webinar. My name is Marty Curtis, and on behalf of all the advisors at Provisions Wealth Planners, I'd like to welcome you to our webinar. As in recent weeks, we are going to be having a guest speaker present about 20 to 25 minutes of prepared remarks, current thoughts on markets and the economy, and from his perspective, what investors can expect in the near term as well as long-term expectations. We've sent our guests some of your questions that we've collected over the week. He'll address them during his comments or immediately following that. Then after that, he wraps that up. We will open up the session for any questions coming in from our audience. Joining us today is Nash Engineer. He's a Vice President of Capital Markets Strategy Group at Fidelity Institutional Asset Management, which is Fidelity Investments distribution and client service organization dedicated to meeting the needs of clients and institutional investors, such as defined benefit and defined contribution plans, endowments, and financial advisors. Nash earned his Bachelor of Technology degree in the metallurgical engineering from the Indian Institute of Technology in Bombay, his Master of Science degree in Materials Science and Engineering from the University of Delaware, and his Master of Science degree in Financial Engineering from the University of Michigan. So with that, thank you, Nash. Really appreciate you taking time out of your schedule to meet with our clients and the advisors, and look forward to your comments.
Thank you, Marty. And just as a piece of administration, is my audio clear? Is my screen share working?
Yes.
Okay, thank you very much. So what I wanted to do today is to break our discussion up into 3 parts. First, we look at the virus crisis, how it's progressed over the world, some very positive developments over the last 24 hours or so in terms of partial reopening of not just a few cities in the US, but across the world. Gilead Pharmaceuticals looking to get early approval on one of their drugs as a therapy. So once we look at the virus crisis from a healthcare perspective, then we look at the impact on the economy, what fiscal packages have been passed, what's likely, and then finally coming to the big question, how are we positioning in terms of asset allocation in this kind of an environment? So let me kick things off on the virus side of things. And we've been utilizing this website, and if you need to get to it, all you need to do is to bring up a browser, type in the words worldometer and coronavirus, and it'll take you out there. And what we like about this website, firstly, is that it's actually set up by a third-party independent research entity. So no political affiliation, no country affiliation. Having said that, I have no control over the ads that you're seeing out here. So don't be distracted by the ads. But what I do like about this website is that they provide you with a lot of details in terms of breakdown by country. Over the last weekend, they've actually added the breakdown by continents. And then they tell you the total number of cases, new daily cases, fatalities, recovered, and even the testing which is being conducted across the world. So let's start with China, where the virus originated. So January 15th, the first set of virus cases are found in the city of Wuhan. Now, Wuhan is a densely populated urban area of 11 million people. 15 days down the road, the Chinese authorities realized that the infections have increased 10,000. So at that point in time, they were left with only one option, which is how do we go about stopping the spread of this virus? And they decided that they would quarantine the entire city of Wuhan, which is 11 million people. So first step, stop the spread of the virus. Second step following that was let's identify everyone who has been infected, take them out of the general population, give them medical assistance, and that's how they went about doing things. So very aggressive testing for the next 6 weeks, all the way up to about the middle of March. And that's where you see that the total cases started to flatten out since then. The daily new cases literally went down to single digits. So that is a template followed widely across Asia, originated actually in South Korea. So in the absence of any effective therapies, as well as a vaccine, that was the most prudent thing to do. Now let's go back and take a look at Europe. So we know over the last 6 weeks, the number of cases in Europe, especially in Italy and Spain, have increased very significantly. So Europe knew what Asia was doing, but despite that, they didn't want to follow in their footsteps. And the reason being that countries like Italy and Spain get 25% of their economy from tourism. So literally they couldn't shut it down. In hindsight, that was not the right decision to take. So come March 21st, the total number of new cases spiked up to 6,557. At that point in time, Italy said, if we don't control it now, it can become a human tragedy. So draconian close down of the entire economy. And 5 weeks down the road, we can see that the count has come down to almost a third, close to about 2,000. So it'll take them another 10 to 14 days to get the count below 1,000, and then we'll start flattening out the curve over the next 4 to 6 weeks. So definitely they are seeing the light at the end of the tunnel. Now let's look at the US. So there are various factors that led to the spread of the virus in the US. So the first set of clusters were in the state of Washington, right outside Seattle in King County. And they followed the Asian template of quarantine that entire county. In hindsight, very good decision to take. The second set of clusters was found in the county of Santa Clara, right next door to where I live in the San Francisco Bay Area. And Governor Newsom followed a similar template, quarantined all the 6 counties, 7 million people. Again, in hindsight, a very good decision to take. But what surprises a lot of people is that why is the count in New York and New Jersey so high, as well as some East Coast states like Massachusetts, Pennsylvania, and the Midwest states of Illinois and Michigan. So starting with New York. So New York passed the shelter-in-place law at the same time that California did. But they didn't think it was prudent to actually enforce it. So that was the first mistake. Secondly, we know New York is an urban, densely populated city. So 8.5 million people, lot of commuters from New Jersey as well as Connecticut. And they all commute via train, which is again a densely populated means of transportation. So all of these factors combine to spread the virus in a very significant manner across New York, New Jersey, and Connecticut. Now, there's a very different reason for why it spread to the other East Coast states as well as to the Midwest. So a lot of kids from the East Coast and the Midwest went down to Florida and Louisiana for the spring break during the months of February and March. And that led to a lot of the spreading of the virus. And when they returned back, excuse me, either to their dorms, more likely to their parents' place, they helped to spread the virus across their communities. So how do we know that? So there's a technology company which went down to one of the popular beaches in Florida. And what they did was they said, let's take down all the mobile phone numbers over a 7-day period on that beach. And let's track where those phone numbers land up 2 weeks and 4 weeks down the road. And that helped them to map out this theory that a lot of this virus spreading across the East Coast and the Midwest primarily came from these spring breakers. So sitting today, what does the situation look like? So if we look at New York, New Jersey, the daily new cases seem to have flattened out over the last week or so. So things are looking good. But if you exclude New York and New Jersey from the US, the rest of the states are still showing a significant increase. So we are not in the clear as yet. And there are two states that we are particularly watching out for. The first one is Florida. So Florida has the maximum number of retirees. So literally 23% of the population in Florida is above the age of 65. And we know those above the age of 65 are extremely vulnerable to this virus. So that's one risk that we are watching out for. The second one is the state of Texas. Now you can see that the number of infections in Texas is actually lower than in Florida and in Louisiana. And it's not because they've been doing all the right things. The reason for it is that they've not been testing adequately. So the last column is the number of tests being conducted for 1 million people in the state or per million people. And as we can see, it's literally half the US average and 1/3 the rate of Louisiana. So once they start testing aggressively, we will see the count increase in a sense. But let's put everything together. And this is a very good schematic map put together by JP Morgan. So as we can see, a lot of Asian countries, a lot of European countries are past the peak, and they are now looking to flatten the curve, gradually start opening up their economies. The US, UK is still about 2 or 3 weeks from hitting the peak of the curve. So that is where we sit in terms of the healthcare issue. So the final point I would make is that there are still quite a few uncertainties with regards to the virus. We are starting to open things up gradually. My hope is that it's gradual and we don't go down the path of opening up restrictions aggressively, because we might see a surge again, which has happened over the month of April in Singapore. So keep all these factors in mind. So literally 2 weeks ago, Singapore was at the peak. They thought that everything was clear. They opened up the economy, and suddenly there were a spike of cases, and now they've actually gone down the curve again. So yes, there are some risks with all of these virus issues. But let's transition and talk about the economy and the impact on the economy. So first we'll talk about China and then we'll talk about the US. So China was growing at about 6% at the end of the fourth quarter last year. Now, first quarter, we know literally over the months of February and March, everything was shut down and a big washout. So we just got the first quarter GDP numbers. They were down a very significant 13%. So GDP, which was growing at 6%, contracted to minus 6.8%. Now, having said that, sitting in the second quarter, when we look at a wide range of indicators, so things like coal production, power production, manufacturing, traffic levels, pollution levels, what it tells us is that on average, the Chinese economy is at about 85% of normalcy. But if we look at consumer indicators, so things like visits to the mall, visits to restaurants, travel for tourism purposes, that's still at the low end of things at about 40 to 45%. So keep these factors in mind, especially as the US is very much a consumer-driven economy. Now, looking at the US side of things. So this morning, we got the first quarter GDP number. It was slightly towards the negative side at minus 4.8%. And primarily because consumer spending dropped very significantly by minus 7.6%. So it's telling us that consumers did start getting a little bit wary itself in the month of February, and that started feeding through in terms of travel, tourism, discretionary spending, all of those things in a sense. So as we sit today, looking at the second quarter, there's a wide range of estimates. So estimates range anywhere from minus 5% down to minus 40%. So based on the number of people who recently been unemployed, so over the last 5 weeks, 26.5 million people have been unemployed. We'll get the next data point tomorrow morning at 8 a.m. Very likely, we are going to get very close to about 30 million people. So taking that as a key factor, our estimate is somewhere in the minus 20% range. Now, a lot of this got already factored into the markets when they corrected by about 30 to 35%. The big uncertainty that the market is dealing with today is firstly on the healthcare side. How soon can we have a recovery? What kind of a recovery will we have? The second one is with all the fiscal packages that they've passed and are likely to pass in a sense. So let's focus on some of those fiscal measures. So totaling up the 4 fiscal packages passed so far, they total about $3 trillion. So US is a $21.5 trillion economy. So literally, it's about 14 to 15% of GDP. So quite significant. In 2009, it was about 9.5% of GDP. But think of these packages more as spending packages, not as stimulus packages. And I want to make this distinction by giving you some details. So within these packages, there's $500 billion for consumers. So if you are a household earning less than $75,000, the federal government per adult will give you a check of $1,200, per child a check of $500. So all put together for a family of 4, you get $3,400. So the question to ask is, how long will that last? So when we look at average salaries across the US, it'll last about 3 weeks in the coastal areas where real estate is expensive, about 6 weeks in the middle of the country where rents and real estate is slightly less expensive. And most of this money will go towards paying rent, mortgages, utility bills, credit card bills, auto loans, and some basic groceries. So there's not a whole lot of stimulus in this package. Similarly, the small business grant that they talk about, and the first one had an allocation of 367 billion. The second allocation was for 380 billion. So all put together about 750 billion. And that will last small businesses anywhere between 6 to 8 weeks, primarily for two things: to pay their rent and to make their payroll. Which brings us to the big issue: what are the politicians looking to do to bring about a vigorous recovery in the second half, in a sense? So about a month ago, President Trump mentioned that he wants to do a $2 trillion fiscal infrastructure spending bill. What surprised us is not what President Trump said, but that Speaker Pelosi actually agreed to it. So presently, the House and the Senate are both on recess. They'll come back on May 4th. Very likely, they'll start working towards this infrastructure package. Very likely, it'll take them about 4 to 6 weeks to complete it, and then it takes about a quarter for the money to actually get spent in the real economy. So we are looking at the impact of this coming towards the end of the third quarter, starting in the fourth quarter. And this will be a very important stimulus bill for the simple reason it will define the growth and the earnings trajectory, not over the next few quarters, but very likely over 2021 as well as 2022. So this is what we are focusing on as we look at the markets today. So having said all of that, how are we positioning in this market? So we've taken what we call as a barbell approach. In plain English, what that means is that you're slightly tilting towards the conservative side of things by looking to own very high quality assets. So on the fixed income side, you want to own core investment grade bonds. So US Treasuries, mortgages, high quality companies like AT&T, Verizon, Microsoft, Amazon, Walmart. You want to do something similar also on the equity side. So more large cap companies rather than small cap companies. The reasoning being they tend to have better quality balance sheets, stronger balance sheets, more flexibility. But if you ask me, I have money to put to work. I'm looking to take a long-term perspective of the markets. Where do you see the best risk reward? The answer to that would be international and emerging markets. And the reason for it is twofold. Firstly, nothing to do with the virus crisis. First factor being they are cheaper in valuations. So today, when we look at the US market, it's trading at about a 3 to 5% discount to its long-term average. When we look at developed markets, which is nothing but Europe, Japan, Australia, Canada, they are trading at about a 20% discount. And when we look at emerging markets, they are trading at about a 30% discount. So that's the first factor. The second factor is everything to do with young demographics. So what we've laid out on slide 19 is the prospective growth of countries based on demographics. So everything on the left-hand side in green is your Western aging world. Everything on the right-hand side in blue is your young emerging market world. And how are we going about capturing this longer-term theme? So there are three underlying themes to playing the demographics. Firstly, it's all about building raw infrastructure. So roads, rails, bridges, power plants, everything that the US built in the 70s and the 80s. The second part is the consumption element. So more people entering the middle class incomes growing, leading to consumption of healthcare products, consumer staples, more discretionary spending on automobiles, retail, travel, and the final component being technology. So increasing usage of smartphones, leading to electronic commerce, finance, banking, and online entertainment. So if you focus on these themes, they can be quite lucrative in terms of investments outside the US. So let me stop there and open it up for questions.
So came in prior. So given this is an election year, how much of the volatility to date do you think has been virus versus oil versus election driven? And what do you think we'll see throughout the balance of the year?
Firstly, excellent question. So let me see if I can do a screen share because we do have a good slide in the presentation.
I don't know how you can get it on your computer or your phone to do that.
So let me first describe how a typical political year looks like, and then we'll take the other two issues of the virus and oil.
Okay.
So in a non-presidential year, which is the red line, typically we see a little bit of volatility and the market on average gives you about 9.5%. If you look at the blue line, which is your presidential election year, the first thing you'll notice is that a lot of volatility in the first half with very little returns. And the reason for it is that the markets hate uncertainty. So the markets want to know who the two candidates are, what are the issues which are going to be discussed. And usually we get that clarity around the time that the national conventions take place. So that's during the summer in a sense. So once we get that clarity, market tends to rally about 5.5%. Then we get a little bit of a hiccup, typically during September, October, and then we get a traditional fourth quarter rally into year end. On average, in a presidential election year, you make about 6.5%. So keep these factors in mind. Maybe this gets reversed in the second half. We might see more volatility in September and October. Now, the virus definitely has an impact because it lowers potential growth, it lowers potential earnings. In terms of oil, I'll make a very brief comment, which is to say, where we sit today, the market is significantly oversupplied versus the demand. And we are at a point where global storage capacity in terms of strategic petroleum reserves, which is usually land-based capacity, is probably going to fill up in about 2 to 3 weeks' time. A lot of the capacity on the sea, which is nothing but tankers, is very much filled up. So if you go to Los Angeles today and you take a pair of binoculars and you look out across the sea, literally you'll see about 4 dozen tankers just parked out there. And lastly, we are now at the stage where we say we are starting to fill up pots and pans. So literally, we are starting to fill up defunct pipelines, railroad wagons, things of that nature. And if we look at the oil futures curve, what it is telling us is that it's going to be a very slow, gradual process in terms of supply and demand coming into balance. So what that curve is telling us is that prices will increase to about $25 to $30 by this December and about $30 to $35 by December 2021. So to us, it's a very challenging environment for a lot of energy companies, especially companies in the shale basins, because their cost of production is anywhere between $25 to $65. So our thinking is that anyone who has a production cost of more than $35 per barrel will find it extremely difficult to survive if this environment prolongs for a longer period of time.
Okay, so given that as a backdrop, what do you think that the impact on the bond market will be? Yeah, given energy company bankruptcies, that type of thing.
Absolutely. So first of all, let's break the bond market into two parts. What we call as investment grade credits, so very high quality credits, and you can throw Exxon and Chevron in there. So absolutely no concerns out there. And then you have the high yield market, which is the more speculative, I should say, the riskier side of the credit market. So within that market, energy credits actually make up about 15 to 16%. And last month, we saw the first bankruptcy in terms of Whiting Petroleum. Very likely, there'll be a whole string of them coming through, not just the energy space, but also the retail space, maybe in the automobile, airline space, hotels, casinos. A lot of credits out there are very much stressed, and we're expecting the default rate to increase. And that's the reason we've not been recommending high income, high yielding credits to investors.
Okay, that makes sense. So speaking of things not to recommend to investors, you've gone through where you think your position is on opportunities in these current market conditions. Where would areas to avoid be?
So on the fixed income side, as I said, more so the high yield space. Yep. On the equity side, we've been reducing positions more in small capitalization companies. If we are looking at sectors, I would say definitely not energy, large parts of consumer discretionary, so airlines, automobiles, restaurants, retailers, hotels, casinos. The sectors that we do like very much are healthcare and technology at this point in time.
Okay. And the question of the day is, has the market found the bottom?
Okay, very good question. So let me bring up this slide. So the first thing I'll say is two things. I am not a technician or a chartist. Secondly, I don't take short-term views. So if you ask me, where will the market be tomorrow, a week from now, a month from now, I'll be honest and tell you, I have absolutely no clue. We are more what we call as value or fundamental based investors. But let's follow this chart, which is quite intuitive. So middle of February, right after Valentine's Day, everybody realizes that the virus is a serious issue. And suddenly there's a herd mentality to sell everything and get out. More out of fear and emotion rather than trying to understand the entire issue and what remedial measures could be taken. So once we start hearing that the Federal Reserve is starting to become active, they're starting to reinitiate all the liquidity programs that they did in 2008 and 9, and they were beginning to make them available to the market, we got the first bounce back in a sense. Then the market said, okay, the Fed is doing something right. What about the politicians? So then we got the CARES Act in a sense, which took us the next step forward. Then we got the CARES Act, the second act. So that's taken us, I think, be close today, very close to, I think, 2950 or somewhere in that range. And if we get the fiscal infrastructure stimulus, now I don't know whether it comes in May, June, July, or August. That may probably take us closer to about 3,000 or 3,200. Having said all of this, as we've laid out, there's also the case, could we go back down again? Yes, if the healthcare issue starts coming back, if the unemployment picture continues to deteriorate, if we start getting more bankruptcies. So I would say today, very much over the summer, we might be in a very big range, somewhere between 2,500 at the bottom, which would be here, and 3,000, which would be somewhere around here.
Okay. Okay, great, thank you. So for the questions that have been posed prior from our clients, I think that's it. I'd like to open it up to everybody in the audience. Does anybody have a question for Nash at this time? No? Okay, good. Well, with that, thank you, Nash. Really appreciate your insight and the time that you've spent with us today. And thank you all of our clients for joining us today. And we look forward to your presentation on next week's webinar, in which we will feature the thoughts and insights from Ken Chambers. He's from PIMCO Funds. The webinar next week will be on Wednesday again. Goodness, that's May 6th already at 3 o'clock. And again, I'd like to emphasize that we really appreciate the trust and confidence that you place in us, and we're continuing to work hard every day to continue to earn that trust and confidence. As in recent weeks, please reach out to your advisor if you have any other questions or comments. Look forward to having you all next week. And with that, I'd like to sign off. Goodbye.
Good.
I don't know if I can.